Kaylee and Lily are both business owners. Kaylee is the owner of Gifts Galore, a unique little gift shop that sells directly to the public. Lily is the owner of Liliana's Warehouse, a company that only sells its merchandise to business owners. Kaylee orders a good bit of the merchandise she sells in her shop from Lily. Both of these businesses are merchandising companies. Do you know what I mean when I use the term merchandising company? A merchandising company is a company that buys goods and then resells them, generally for a higher price than they were purchased. There are two types of merchandising companies, retail and wholesale. A retail company is a company that sells products directly to customers, where a wholesale company is a company that buys items in bulk from manufacturers and resells them to retailers or other wholesalers. Now that you know what retailers and wholesalers are, can you distinguish between Kaylee and Lily's businesses? Since Kaylee sells directly to the public, she owns a retail shop. Lily doesn't sell her merchandise to the general public. She only sells to businesses. That makes her the owner of a wholesale company. But regardless of whether a company is a retail or a wholesale company, there are a few activities that are common among the two: purchasing, selling, and the operating cycle. Purchasing means that you buy a good from someone in exchange for cash. It depends on how big or small a company is as to how complex the purchasing system is. For Kaylee, who is a small business owner, purchasing is simple. She decides what items she wants to sell in her store, places the order, receives the order, verifies the order, and then places items in inventory. It's a little different for Lily. Her warehouse acts as a supplier to a number of different retail stores, so it's a much bigger company than Kaylee's. Because of the importance of keeping items in stock for her customers, Lily has created a department that's solely in charge of purchasing. Her purchasing manager, Jill, decides on the items that need to be purchased and fills out a purchase requisition for the items. She turns that requisition over to Lily, who then approves or denies the requisition. Upon approval, Jill orders the merchandise and makes sure that upon receipt everything is ordered. Selling is pretty simple. It simply means that someone buys a good from you in exchange for cash. One more concept that's common among both retail and wholesale companies is the operating cycle. The operating cycle for a product is the amount of time that exists between the purchase of the item and sale of the same item. If Kaylee buys an item today and sells it in 2 weeks, then the operating cycle for that item is 2 weeks. Now, all merchandising companies have to have some type of system to keep up with their inventory. They have two options to choose from: a perpetual system or a periodic system. A perpetual system is a system that updates inventory as each sale is made, while a periodic system is a system that updates inventory at a specific point in time. The common time frame for updating a periodic system is once a quarter. Perpetual systems are ideal because they give you actual inventory counts at any given point in time, but they usually have a very expensive initial cost to implement. Periodic systems are much less expensive to implement, but lack the capability of giving you an up-to-date inventory count at any given time. Since Kaylee's company is a small company, what inventory system do you think she should use? If you guessed periodic, you're correct. Why? Well, for 2 reasons. First of all, her company is small enough that she doesn't have to keep a large inventory of items in stock. She can count her inventory with no problem and will not benefit from the expense of installing a perpetual inventory system. Lily, on the other hand, has a much bigger operation than Kaylee. She has a massive inventory that must be maintained for the benefit of her business associates. She would benefit from the perpetual inventory system. Why? Because of the high volume of inventory she must keep and the large amount of purchases and sales that occur in her company, there's a need for up-to-date inventory counts. It would be a wise investment for Lily to implement the perpetual inventory system. Since inventory is something that a business owns, it's considered an asset and reported as such on the balance sheet. The dollar value that corresponds to the inventory account depends on the valuation method that's used. One method commonly used is called FIFO, which is short for first in, first out. In this type of valuation, you assume that the first items that are added to inventory are the first ones sold. Another method is the LIFO method. In this method, the assumption is that the last items added to the inventory are the first items sold. So let's calculate the value of one inventory item at Lily's warehouse at the end of the accounting period based on the following information. There were 100 frame prints purchased for inventory during this accounting period. Their purchase dates and price were April 10th, 2014, Lily purchased 15 frame prints at $4.49 each. On April 22nd, she purchased 10 more frame prints at $3.99 each. On May 13th, she purchased 30 more at $3.09 each. On May 26th, Lily purchased 20 more frame prints at $3.59 each. On June 19th, she purchased 25 more at $3.30 each. A total of 85 prints were sold during this time period. Using the FIFO method, what is the value of the prints still left in stock? To calculate this, we assume that the first 85 were already sold, so that would leave 15 prints in stock from the June 19th purchase date. Since they were purchased at $3.30 each, then the inventory value would be recorded for the prints at $49.50. But what would be the value if the LIFO method was used? In this instance, you assume that the last prints added to inventory were the first ones sold. Taking into account that 85 were sold, that would leave the original 15 prints in inventory from the April 10th purchase date. They were purchased for $4.49 each, which would make the inventory value to be recorded in the accounting records $67.35. Now that you know the type of activities that are involved in merchandising, as well as the need to implement an inventory system, let's get to the grassroots of what any business is all about: money. Now here's the question of the hour. How is income reported for a merchandising company? The first thing that I can tell you when answering this question is that the amount of money that's collected from a sale is not the amount of money reported in the financial statements as income. There's a specific formula that has to be used to figure out how much money a company actually made during an accounting period. That formula is sales minus cost of goods sold minus expenses equals net income. You already know what sales are. Expenses are quite simply the cost associated with running a business. So now let's talk about the elephant in the room, the cost of goods sold. The cost of goods sold is the cost of the merchandise that was sold to customers during a given time period. There's also a formula that's needed to calculate the cost of goods sold. It's beginning merchandise inventory plus new purchases of inventory minus ending merchandise inventory equals cost of goods sold. I know that's a pretty good bit of information to absorb, isn't it? But thank goodness we have examples that can help all this sink in. So let's figure out the amount of income that will be reported on the income statement from Kaylee's company. For the quarter ending June 30th, 2014, Gifts Galore had the following. Sales were $38,000. Beginning merchandise inventory was $8,200. Inventory purchases were $13,169. Ending merchandise inventory was $10,279. Expenses were $17,955. What's the cost of goods sold and the net income for Gifts Galore during this accounting period? Since we need the cost of goods sold to calculate the net income, we'll figure it first. Cost of goods sold equals beginning merchandise inventory plus inventory purchases minus ending merchandise inventory. So cost of goods sold equals $8,200 plus $13,169 minus $10,279 equals $11,090. So the cost of goods that were sold during this accounting period totaled $11,090. Now we can calculate the net income that the company had for this quarter. Net income equals sales minus cost of goods sold minus expenses. So net income equals $38,000 minus $11,090 minus $17,955. So the net income was $8,955. When it comes to merchandising companies, there's a lot to learn. First of all, there are two types of merchandising companies, retail and wholesale. A retail company is a company that sells products directly to customers. A wholesale company is a company that buys items in bulk from manufacturers and resells them to retailers or other wholesalers. In order for a merchandising company to operate, there are certain activities that must take place. The first thing that has to be done is purchasing. Purchasing means that you buy a good from someone in exchange for cash. The next activity is selling. Selling means that someone buys a good from you in exchange for cash. The amount of time that exists between the purchase of the item and the sale of the item is called the operating cycle. Keeping up with the amount of inventory requires that the merchandising company implement an inventory system. There are two systems that a company has to choose from, periodic or perpetual. A perpetual system is a system that updates inventory as each sale is made, while a periodic system is a system that updates inventory at a specific point in time. Along with deciding what type of system to use to keep up with the amount of inventory that a company has, the decision also has to be made on how to value that inventory. One method commonly used is called FIFO, which is short for first in and first out. And in this type of valuation, you assume that the first items that are added to inventory are the first ones sold. Another method is the LIFO method, short for last in, first out. In this method, the assumption is that the last items added to inventory are the first items sold. All of these specific activities have to be in place in the merchandising company before the company can report income. The amount of income that is reported in the financial statements is not given by the click of a mouse, but must be calculated. The formula to calculate net income is sales minus cost of goods sold minus expenses, which equals net income. Sales and expenses are generally already known. However, the cost of goods sold must be calculated. The cost of goods sold is the cost of merchandise that was sold to customers during a given time period. The formula to calculate this is beginning merchandise inventory plus new purchases of inventory minus ending merchandise inventory, which equals cost of goods sold. Once the cost of goods sold is calculated, that number is substituted into the net income equation, and the calculation can be made to determine the amount of money made or lost in the given accounting period. As you can see, merchandising companies, though simply seen as someplace to buy things from a customer's point of view, are really rather complex. When you go into a store and see all the items that store has available for sale, you know each of those items are part of the store's merchandise inventory. But what most people don't know is that there's more to merchandise inventory that meets the eye. Before we discuss what else is part of merchandise inventory, let's define the term itself. The term merchandise inventory refers to items that are acquired by a distributor for the purpose of resale to a third party. Not only are the items that you see on display in a store considered merchandise inventory, but there are also three more things that are considered to be part of merchandise inventory. They're goods in transit, goods in consignment, and goods damaged or obsolete. We'll start our discussion on the other components of merchandise inventory with goods in transit. Technically, goods in transit are items that have been ordered by a business but not yet received. Now, does that mean that everything a business has ordered at the time that merchandise inventory is recorded in the accounting records should be counted as well? Most definitely not. For goods in transit, the question of ownership comes into play. Ownership of items that are in limbo between being shipped and received lies in the terms in which the items were shipped. Items that are shipped FOB shipping point are items whose ownership is transferred from the seller to the buyer as soon as items ship. FOB destination are items whose ownership transfers from the seller to the buyer when the items are received by the buyer. In order for goods in transit to be recorded in the accounting records of a business before receipt, they must have been shipped FOB shipping point. Let's look at an example of this concept. Avery owns a furniture store. She orders 10 new armchairs for the store with the terms FOB shipping point from Hart's Custom Furniture. On the same day, she orders 10 sofas from Gartman's Wholesale Furnishings. The sofas are ordered with shipping terms FOB destination. It's the end of the accounting period and Avery has to record her merchandise inventory in her accounting records. Neither the armchairs nor the sofas have been received yet. So which of these items need to be counted as merchandise inventory for the current accounting period? The answer here is the 10 armchairs. Why? Because ownership of the chairs transferred to Avery when the items shipped based on the shipping method that was agreed upon between Avery and Hart's Custom Furniture. So why didn't the sofas count as merchandise inventory on Avery's accounting records? Because Avery has different shipping terms with Gartman's Wholesale Furnishings. The order she placed with Gartman's has the shipping terms FOB destination, meaning that ownership of the sofas remained with Gartman's until the sofas are received. When Avery receives those sofas, at that time ownership will then transfer to Avery. Goods in consignment are another category of items that fits into merchandise inventory. These types of goods are items that are delivered from one business to another business for the purpose of allowing the second business to sell the items on a commission basis. In this type of relationship, The business that owns the goods is called the consignor, and the business that sells the goods for commission is called the consignee. Even though the goods given to a consignee by a consignor are physically located in the consignee's business, the ownership of those items remains with the consignor. Is all this consignor-consignee business confusing you? But don't worry, this next example will bring it all together. Avery has decided that she would like to expand the items that she sells in her furniture store. Her friend Tim makes coffee tables and end tables out of reclaimed wood. She offers to let Tim put some of his pieces in her store on a consignment basis. She does not purchase the items, but she does sell the items. She makes 10% commission on every item that she sells for Tim. Who is the consignor here? What about the consignee? Who has ownership of the consigned items? The consignor here is Tim, since he's the one who has made the items. The consignee is Avery, since the items are at her store yet she didn't purchase them. Tim retains ownership of the items he places with Avery on a consignment basis. But when it comes time to value merchandise inventory, Tim counts any items that are at Avery's furniture store on his accounting records, and Avery does not. Another thing that's common among every merchandising business are damaged and obsolete goods. These are the type of goods that have been damaged while in inventory or are no longer being made. A business has two ways to handle damaged or obsolete goods. If they can be sold at a reduced price, then the goods are counted in merchandise inventory at their net realizable value. The net realizable value of a good is its sale price minus any selling costs that were incurred in the sale of the item. If an item can't be sold, then that item is not counted as merchandise inventory in the accounting records. Let's go back to Avery's furniture for an example. Avery has 2 sofas and 3 recliners that are damaged. She also has 1 love seat that's obsolete. She can sell 1 sofa, 1 recliner, and the love seat at a discounted price. 2 of the recliners are too damaged to sell. Which of the items will be counted in her merchandise inventory and which will not? Well, since the 1 sofa, 1 recliner, and the love seat can be sold, they are counted in the merchandise inventory, but at a lower value than what they would have had if they had been in perfect condition or had not been obsolete. Merchandise inventory refers to items that are acquired by a distributor for the purpose of resale to a third party. When discussing what makes up merchandise inventory, the most important thing that you can learn is that merchandise inventory is much more than just what you see when you enter a store. There are 3 more categories of items that are included in merchandise inventory: goods in transit, goods in consignment, and goods damaged or obsolete. Goods in transit are items that have been ordered by a business but not yet received. Though many items fit the goods in transit category, only those that are shipped FOB shipping point are included in merchandise inventory counts. Why? Because items shipped FOB shipping point are items whose ownership is transferred from the seller to the buyer as soon as items ship. Some items are ordered with shipping terms of FOB destination. FOB destination are items whose ownership transfers from the seller to the buyer when the items are received by the buyer. Items that are considered goods in consignment are also part of the merchandise inventory of a business. Goods in consignment are items that are delivered from one business to another business for the purpose of allowing the second business to sell the items on a commission basis. In this type of relationship, the business that owns the goods is called the consignor, and the business that sells the goods for commission is called the consignee. The ownership of the consigned goods remains with the consignor until the time of sale. Items that are considered damaged or obsolete goods are the types of goods that have been damaged while in inventory or are no longer being made. Some of these goods may be able to be sold at a discounted price, and some will not be able to be sold at all. If the goods are able to be sold, then they are counted in merchandise inventory and valued at their net realizable value, which is the item's sale price minus any selling costs associated with the sale. If the item can't be sold, it's not counted in merchandise inventory. So now that you know a little more about the merchandise inventory, you can see what I mean when I said there's certainly more to it than meets the eye.
Have you ever been to a Shoppers Club warehouse? If so, then you know how amazing it is to walk into this big building full of all sorts of items. I love Have you ever been to a Shoppers Club warehouse? If so, then you know how amazing it is to walk into this big building full of all sorts of items. I love going and buying things in bulk, and I'm always amazed at how much inventory there is stocked up on the shelves. I've never really thought about how much that inventory has to cost the company. In my mind, if they bought it wholesale, then the price of the inventory is the actual purchase price that was paid for the item. However, my way of thinking is incorrect. You see, in all actuality, inventory costs are not only the price that was paid to purchase an item, but also the cost of storing and maintaining that item for however long it takes it to sell. Inventory costs can be broken down into three categories: ordering costs, carrying costs, and shortage costs. These are the only costs that will appear on the financial statements. The following costs are useful information for management, but they're not inventory costs per GAAP. When I think about my trips to my local Shoppers Club warehouse and why I love going, it really is because of the variety of products that they have. Somebody had to order all this stuff. Somebody had to deliver the products, and somebody had to receive the products and then put them on the shelves. Did you know that all these things are part of ordering costs? Ordering costs are the costs that are incurred to prepare and process purchase orders and to receive and inspect merchandise that has been ordered. The pay that is received by the people that order inventory, deliver inventory, and receive and stock inventory is considered an ordering cost. If purchase orders are written up or printed, the cost of the purchase orders is also considered an ordering cost. The next component of inventory costs are carrying costs. Carrying costs are the costs that are related to keeping inventory in stock. Do you think that inventory purchased is paid for by money that the company has in its bank account? Maybe some of it, but a part of the money used to purchase inventory comes from financing activities, whether it be bank financing or investor-centered financing. Both types of financing results in interest fees. These interest fees are part of carrying costs. I mentioned previously how I was amazed at the amount of inventory items that were stored in visible areas of the warehouse. I can't even imagine how much was stored that I couldn't see. Regardless of where it is stored, the expenses of storing the inventory and keeping it in good condition are all considered storage space costs. These include the electricity that is needed to provide lights, air, and heat for the warehouse. They also include any building rent that is paid on the warehouse and business locations, the purchase cost if a building is purchased, and the real estate taxes associated with each. Storage space costs are also part of carrying costs. Another important part of carrying costs comes in the form of risks that are made by a company when inventory purchases are made. What if all the inventory doesn't sell? What if competitors lower their prices on the same item? What if inventory is stolen or damaged? These are all risks that have a monetary value to them. For instance, say I walked into the store and saw that they had grapes on sale for $1.69 a pound. When I go to look in the bin and get a nice bundle, I see that there are also containers of grapes that are discounted to $1 a pound. These are grapes that are older than and not as pretty as the more expensive ones. If any of those grapes sell, then the company loses 69 cents a pound on them. If they don't sell, then the company loses all the money that they spent purchasing the grapes as inventory. That risk of losing money on inventory is also part of carrying costs. The third component of inventory costs is shortage costs. Shortage costs are the costs that a business incurs when they run out of stock. For example, let's say that the local Shoppers Club warehouse advertises a specific brand of television for a really good price. The person in charge of ordering forgets that these televisions will be going on sale and only orders 5. When the sale starts, the televisions sell out within a few hours. More have to be ordered and need to be shipped as quickly as possible. The quick shipping comes at an expensive price. That added cost is an example of a shortage cost. Another prime example of a shortage cost is having to pay a higher wholesale cost on an item to quickly replenish inventory. Now, here's a question that I bet you're asking yourself. Why is inventory cost so important? At the end of the day, the one thing that business owners want to know more than anything is how much money the business is making. If it's not making as much as it should, then there needs to be adjustments made. In order to figure how much money is being made from sales, then you have to know 2 things. Number 1, you have to know the total dollar amount of sales for the period. Number 2, you have to know how much the items that were sold cost. The cost of goods sold, also known as COGS, is the total dollar amount, including inventory costs, that a business paid for items sold. Once you know these two numbers, then you simply subtract the cost of goods sold from sales to get profit or loss from sales. Let's look at an example of this. I paid $599 for a 52-inch television. The wholesale cost of the television was $330. It cost $29 for shipping and a total of $47 for warehousing costs. The total cost of goods sold was $406. The profit from the sale of the television was $599 minus $406, which equals $193. Notice that the cost of goods sold amount was more than the wholesale cost. That is because we had to include everything that is part of the inventory cost. When I go shopping, I never think about all the little pieces that make up the price of the items that I buy. It's amazing to realize just how much is involved in the cost of inventory. Inventory cost is not only the price that was paid to purchase an item, but also the cost of storing and maintaining that item for however long it takes to sell. It can be broken down into three categories: ordering costs, carrying costs, and shortage costs. Ordering costs are the costs that are incurred to prepare and process purchase orders and to receive and inspect merchandise that has been ordered. Carrying costs are the costs that are related to keeping inventory in stock. Shortage costs are the costs that a business incurs when they run out of stock. Knowing inventory costs is an essential part of knowing the total cost of goods sold. The cost of goods sold is the total dollar amount, including inventory costs, that a business paid for items sold. In order for a business to calculate how much money that it actually made from sales, the cost of goods sold is subtracted from the total sales to get the bottom line proceeds made from the sale of goods.
I have always wanted to open my own business. I can mentally picture it. The store layout, the bright neon sign flashing the word open, and customers just streaming in. However, I know it really isn't that easy. There are so many things that have to be done to successfully operate a business. One of those, and a very important one, is accounting for inventory purchases. Inventory purchases, in the sense of a merchandising company, refers to buying items that are meant to be resold to customers. In order to keep your accounting records straight, all of the purchases made in an accounting period must be recorded. But before inventory purchases can be recorded, the value of the inventory has to be calculated. Now, there's a pretty straightforward way to calculate the total cost of purchasing inventory. You simply use the following formula. Original selling price minus trade discounts minus purchase discounts minus purchase returns and allowances plus transportation cost plus ownership and transfer fees equals cost of purchasing inventory. I know that's a lot to grasp at one time, so let's break it down and discuss each part of the equation. The original selling price is easy. It's the price that's on the price tag or in the catalog. The original selling price is quite simply the base price of the item. Let's say that I own a candy store and I want to order 40 pounds of gummy worms from Willie's Candy Direct. The original selling price per pound for the gummy worms is $6, so my total purchase for the candy is $240. A trade discount is the amount of discount that is given by a manufacturer to a reseller on the price of an item. Oftentimes, trade discounts are given to customers who order in bulk. For example, Willie's Candy Direct offers a 20% discount for any candy orders over 25 pounds. Since I ordered 40 pounds of gummy worms, then I'll get the 20% discount, and that discount will total $48. Purchase discounts are different than trade discounts. They're discounts that are given by suppliers to merchants for paying invoices on time. Remember the gummy worms that I just ordered from Willie's Candy Direct? I ordered the gummy worms on account with the terms 3% net 10. What that means is that if I pay the total invoice amount within 10 days of receiving the invoice, then I can deduct 3% of the invoice as a discount. So if the invoice is $192, then I would be able to deduct $5.76 from the total and only pay $186.24. Now that's as long as I paid the invoice within the 10-day time period. Purchase returns and allowances are any credits that a buyer may be issued by the seller for damaged or returned goods. Let's say that of the 40 pounds of gummy worms that I ordered, several of the candies were melted together. I can't sell them that way, so I need to return them. The first thing that I do is weigh the melted candies since I purchased them by the pound. I need to know how much of the candy has to be returned. I certainly don't want to pay for something that I can't sell. Since I paid $4.80 a pound after my trade discount, and there are 5 pounds of melted candy that must be returned, my credit allowance is $24. That amount is deducted from my total invoice before I pay it. Now that we've discussed everything that's deducted from the original selling price of an item, let's talk about what is added in the equation. Transportation cost is the first thing that is added. Transportation cost is the cost of moving merchandise from one place to another. When it comes to adding transportation cost to the cost of purchased inventory equation, it's very important to remember that only the cost of merchandise coming in is added. The cost of merchandise going out is categorized differently, and it's not a part of accounting for inventory purchases. If it cost me $8.10 to get the gummy worms from Willie's Candy Direct to my store, then that's the dollar amount that I must add in the equation. The last component of the cost of purchases equation is ownership and transfer fees. Ownership and transfer fees are any fees associated with transferring ownership of an asset from one business to another. Not every inventory purchase will have ownership and transfer fees associated with it. For example, when I ordered the gummy worms from Willie's Candy Direct, I didn't pay ownership or transfer fees. If, however, I was in a different line of business, say a used car lot, I would have ownership and transfer fees that would have to be paid. Why? Because the inventory that I would acquire would be used cars. When the used cars are purchased, there must be a title transfer to transfer ownership, which requires a title transfer fee. Now let's put it all together and figure out the cost of purchasing inventory from my candy store. Here's what I know. I purchased 40 pounds of gummy worms with an original selling price of $6 per pound. Since I ordered more than 25 pounds of gummy worms, I get a 20% trade discount off my order, which results in a discount of $48. I get an additional 3% purchase discount if I pay the entire invoice for the candy purchase within 10 days. That discount amount is $5.76. Of the 40 pounds of gummy worms that I ordered, 5 pounds were not able to be sold, so Willie's Candy Direct credited me $24. Transportation costs were $8.10. I did not pay any ownership and transfer fees. Remember the equation for calculating the cost of purchased inventory? It's original selling price minus trade discounts minus purchase discounts minus purchase returns and allowances plus transportation cost plus ownership and transfer fees. That would be $240 minus $48 minus $5.76 minus $24 plus $8.10 for a total of $170.34. So we now know that the cost of purchasing the gummy worms for inventory is $170.34. Now that the calculation of the cost of purchasing inventory has been made, how is it recorded in the accounting records? Now this is the easy part of the process. Any transaction entered into the accounting record has to have a debit to at least one account and a credit to at least one account. For this transaction, the asset account purchases is debited. The purchases account is used only to record the purchase cost of items that are intended to be resold. When merchandise is purchased on account, then the accounts payable account is credited for the amount of the purchase. If the merchandise is paid for at the time of purchase, the cash account is credited. The purchase of the gummy worms from my candy store would be entered into the accounting records with a journal entry that looks like this. November 1st, purchases are debited $170.34. Accounts payable is credited $170.34. There is certainly more to operating a business than meets the eye. One of the most important things that must be done in business operations is to record the inventory purchases made during each accounting period. Inventory purchases refers to buying items that are meant to be resold to customers. Before these purchases can be recorded in the accounting records, the value of the purchases has to be calculated. The best way to do this is to use the equation original selling price minus trade discounts minus purchase discounts minus purchase returns and allowances plus transportation cost plus ownership and transfer fees equals cost of purchasing inventory. The original selling price is the price that is on the price tag or in the catalog. A trade discount is the amount of discount that is given by a manufacturer to a reseller on the price of an item. Purchase discounts are different than trade discounts. They're discounts that are given by suppliers to merchants for paying invoices on time. Purchase returns and allowances are any credits that a buyer may be issued by the seller for damaged or returned goods. Transportation cost is the cost of moving merchandise from one place to another. Ownership and transfer fees are any fees associated with transferring ownership of an asset from one business to another. Once all of these values are substituted into the equation, the cost of inventory purchases is calculated. That value is then recorded in the accounting records by a debit to at least one account and a credit to at least one account. The purchases account, which is used only to record the purchase cost of items that are intended to be resold, is the account that is debited. If the purchase was made on account, then the accounts payable account is the one that is credited. If the purchase was made in cash, the cash account is credited. Once this transaction has been entered into the accounting records, then and only then can it be reflected on the company's financial statements. After months of hard work and planning, Janie's in the final steps of opening her new business, Janie's Boutique. She's already filled the store with inventory, hired employees, and will be opening the doors in just a few days. But she's run into a slight problem. She can't quite decide how to account for her inventory. She knows that she wants to make sure that her financial statements are as accurate as possible, and that will require that her inventory cost and sales be as accurate as possible. But what she doesn't know is what's the best way to do this. Since Janie doesn't know what to do, she decides to go see her friend Adam, who is an accountant, and get his advice. Adam's glad to talk to Janie about this. The first thing he tells her is that she needs to decide what inventory system to use. An inventory system is a system used to monitor the levels of inventory that a business has on hand. He tells her that she has two choices when it comes to inventory systems, periodic or perpetual. Which one is best for her needs? Well, she'll just have to decide that. Adam explains to Janie that a periodic system is an inventory system that records inventory levels at specific points in time. These points in time are usually at the end of accounting periods. Periodic systems use physical count audits, where employees actually count each and every item in the store to get an accurate inventory level. This amount is then compared to sales reports and purchase receipts to verify the amount of goods sold and to see if there are any discrepancies in numbers. On the other hand, a perpetual system is an inventory system that records inventory into the accounting system on a continuous basis. This type of system relies heavily on automation to instantly track purchases and sales and update the accounting system immediately. When an item is purchased, it is automatically recorded in the accounting system as an inventory item. Janie was confused. What makes one better than the other? Adam tells her that one is not necessarily better than the other, but there are a couple of notable differences between the two. One major difference is the account each system uses to record the acquisition of inventory-related materials. The periodic system uses the purchases account, while the perpetual system uses the inventory account. Another difference between the two systems is that the periodic system only reports the cost of goods sold at the end of the accounting period, while the perpetual system constantly updates this information at the time of each sale. The importance of the cost of goods sold is that it is the account that reports the direct costs that are attributed to the goods sold by a company. The cost of goods sold is reported on a business's income statement, which is a financial statement that tells how much money a business made or lost in a given time period. The cost of goods sold is deducted from revenue earned from sales to get the total amount of profit or loss that a business had from sales in an accounting period. A third difference between the two centers on closing entries. Closing entries are entries that are made at the end of the accounting period to update the balances of certain accounts. The periodic system requires closing entries to update the balances in the inventory and cost of goods sold account, where the perpetual system doesn't need closing entries because they always update those accounts. A fourth difference, and one that is important to business owners, is the cost of implementing either system. The perpetual system is highly technological, so it costs much more than the manual periodic system. Janie knows that she needs to make a decision on what type of inventory system to use for the boutique. After talking with Adam, she learned there are two types to choose from, periodic or perpetual. The periodic system is an inventory system that records inventory levels at specific points in time. The perpetual system is an inventory system that records inventory into the accounting system on a continuous basis. She also learned that there were distinct differences between the two. One of those differences is the account that is used to record the acquisition of inventory-related items. The periodic system uses the purchases account, while the perpetual system uses the inventory account. Another difference is the way that the cost of goods sold are reported. The cost of goods sold is the account that reports the direct costs that are attributed to the goods sold by a company. It is significant to a business because it helps determine exactly how much a company made or lost on sales for the accounting period. The cost of goods sold is reported on the income statement, which is a financial statement that tells how much money a business made or lost in a given time period. In the periodic system, the cost of goods sold are only reported at the end of an accounting period, whereas in the perpetual system, cost of goods sold is continuously updated with each new purchase or sale of inventory. Janie also learned that if a business used the periodic system, then closing entries, or entries that are made at the end of an accounting period to update the balances in certain accounts, would be required to update the merchandise inventory and the cost of goods sold account. Since the perpetual system updates these accounts with every sale made, then it doesn't require closing entries. The last difference that Janie learned was that the perpetual system was more expensive to implement than the periodic system because of its heavy reliance on technology. After reviewing all the facts, Janie finally decides to use the periodic system since she has a very small business.
Sarah is in the process of opening her own business. Today she's going to get her inventory ordered. With the help of her accountant, she has already decided what type of inventory system to use to help her keep a check on the comings and goings in her inventory. Because a perpetual system is an inventory system that continually updates the inventory account with each purchase and sale, it is the system Sarah has chosen. Sarah really wants to understand a little more on how to record transactions in her accounting books, so let's see if we can help her. The first thing that Sarah needs to know is that transactions are recorded based on the double entry accounting system. This system requires that for every one transaction that occurs in a business, at least two accounts are affected. One account is debited and one account is credited. A debit is an entry on the left side of an account that increases the balance in asset accounts and decreases the balance in liability and equity accounts. A credit is an entry on the right side of an account that decreases the balance in an asset account and increases the balance in liability and equity accounts. Why are debits and credits important? Well, the answer to that question is very important. The entire concept of accounting is based on one equation called the accounting equation. The accounting equation states that assets equal liabilities plus owner's equity. Assets are something that a business owns. Liabilities are something that a business owes. Owner's equity is the amount of money that the business owner has personally invested into the business. No matter what happens in the course of an accounting period, the accounting equation must always be kept in balance. That occurs by debiting one account and crediting another. The best way to really get the point across about recording purchases is to do just that, so let's look at some examples. Let's say that Sarah orders $5,000 in merchandise inventory and pays for it in cash. How would she record this transaction in her accounting records? Let me give you a few hints. There are two accounts that are affected in this transaction. Since she purchased merchandise inventory, then the inventory account balance needs to increase. She paid for her purchases with cash. This means that the balance in her cash account decreases. Since both of these accounts, inventory and cash, are something that the business owns, they're asset accounts. To increase the balance in an asset account, that account is debited. To decrease the balance in an account, the account is credited. Now that I've given these clues, what do you think should be done? I hope you answered, debit the inventory account and credit the cash account. Let me show you how this looks in the actual accounting ledger. December 1st, inventory $5,000, cash $5,000. Now, what if the merchandise was not paid for in cash but was bought on account? On account means that Sarah takes ownership now and agrees to pay for the merchandise at a later date. Anything that is bought on account creates an accounts payable. Because an accounts payable is something that Sarah owes, then it is a liability account. In order to increase the balance in a liability account, that account must be credited. The inventory account will also increase with this transaction. Once again, since inventory is something that a business owns, it is an asset account and must be debited to increase its balance. With all of that being said, how do you think Sarah should record the purchase of inventory on account? I hope that you said that the inventory account should be debited $5,000 and the accounts payable account should be credited $5,000. In this case, the general ledger entry would look like this. December 1st inventory $5,000, accounts payable $5,000. Now, what happens when Sarah pays on the account? Let's say that on December 31st she pays $2,500 for payment of her account balance. In this case, she needs to decrease the balance of the accounts payable account, since she did pay on the bill. Does she need to increase the balance on any account here? Actually, no. When she pays her payment, the balance in the cash account will decrease just as the balance in the accounts payable account. Is that okay? Yes, it is. Remember, the double entry accounting system does not require that one account balance decrease and one increase. It simply requires that a debit and a credit be made. A debit increases the balance in an asset account and decreases the balance in a liability account, which is what the accounts payable account is. The credit here will go to the cash account, since a credit decreases the balance in an asset account, which is exactly what the cash account is. The journal entry would look like this. December 31st, accounts payable $2,500, cash $2,500. Since Sarah is using the perpetual inventory system, each and every transaction will be journalized at the time of purchase. Any business that is in operation must choose a way to handle their inventory in their accounting records. The perpetual system is an inventory system that continually updates the inventory account with each purchase and sale. In order to update the account and keep the accounting records correct, the transaction must be recorded in the accounting records. Transactions are recorded using the double entry accounting system, which requires that for every one transaction that occurs in a business, at least two accounts are affected. One account is debited and one is credited. A debit is an entry on the left side of an account that increases the balance in asset accounts and decreases the balance in liability and equity accounts. A credit is an entry on the right side of an account that decreases the balance in an asset account and increases the balance in liability and equity accounts. Debits and credits are used so that the accounting equation, which states that assets equals liabilities plus owner equity, remains in balance. Assets are something that a business owns. Liabilities are something that a business owes. Owner's equity is the amount of money that the business owner has personally invested into the business. It depends on how much merchandise inventory is purchased as to what accounts are affected in the accounting records. If inventory is purchased with cash, then the inventory account is debited for the value of the merchandise purchased and cash is credited for the purchase. If the inventory is purchased on account and will be paid for at a later date, then the inventory account is still debited, but the accounts payable account is credited. When payment is made on the account, then the accounts payable account is debited and the cash account is credited. Once the entries are made for each transaction when it occurs, then the transaction is reflected.
The goal of any merchandising operation is to make money, but in order to do that, two things have to occur: purchases and sales. In this lesson, we're going to talk about the sales portion of a merchandising business. Though I'm sure you already know what sales are, I'm going to take the time to define that term. Sales are the transfer of ownership of goods between a merchant and a customer for money. There are two types of sales that occur in the merchandising world. Cash sales are sales that are made where payment is received immediately. For example, let's say that I go to the furniture store and buy new living room furniture. The total cost of the furniture is $2,500, and I pay that at the time of the sale. I have created a cash sale. I could use cash or my credit card, and the store receives payment immediately. It's important to note here that when we talk about cash sales, That includes items paid for with commonly used credit cards, like MasterCard and Visa. Now, let's say that instead of paying for the furniture at the time of purchase, I open a store credit account and I make monthly payments to the furniture store until the furniture is paid in full. Credit sales that are considered sales on account are sales made on specific terms with payment being expected at a later date. Now, each credit sale that occurs within a business creates what is known as an accounts receivable within the business. An accounts receivable is money that's owed to a business for goods or services purchased by a consumer and paid for over time and in terms set forth by the seller. In order for a company to be able to accurately report its financial position on the company financial statements, it has to account for every transaction that occurs in the business, including sales. Before sales transactions can be recorded, there are a few things that have to be taken into consideration. One thing that needs to be taken into consideration when it comes to recording sales are any sales returns and allowances that have occurred in the specific time period. Sales returns and allowances are either merchandise that's been returned by a customer or allowances given to a customer because of defective merchandise. Now, what if I decided that of the furniture that I bought, I wanted to return the armchair because it didn't fit in my living room? In that case, my account at the store would be credited for the purchase amount of the chair, and the amount of net sales for that transaction would decrease. Once again, if there are any credits or allowances given, they're deducted from the sales total. Another concept that's important in regards to inventory sales is the cost of goods sold. The cost of goods sold is the dollar value associated with inventory items that have been sold. This amount is not the amount that the merchandise sold for. It's the amount that was paid for the merchandise, including any associated costs, such as shipping, receiving, and storage cost. Why is cost of goods sold important when accounting for inventory sales? Well, the answer to that is pretty straightforward. Whenever a sale of merchandise is made, the cost of that merchandise that was sold has to be deducted from the proceeds from the sale to get the amount of profit that was made by the sale. Now that you know a little more about sales, let's talk about how these sales are recorded in the accounting records. Any transaction that's posted in an accounting journal requires a debit to at least one account and a credit to at least one account. Now, when it comes to sales of inventory, there are actually two entries that must be made into the accounting system. The first entry records the actual sale with a debit entry to an asset account and a credit entry to a revenue account. The second entry requires a debit to the cost of goods sold account and a credit entry to the inventory account. This allows the accounting records to show the amount of sales that were made, the cost of the goods that were sold in each transaction, and the value of the inventory that must be removed from the store inventory for each transaction. Recall the furniture that I bought earlier and paid cash. Let's assume that the cost of the furniture was $2,000. Now, notice that wasn't the sale price. That's the cost of the furniture. That journal entry would look like this. Cash would be debited $2,500. Sales revenue would be credited $2,500. Cost of goods sold would be debited $2,000. Inventory would be credited $2,000. That's two separate journal entries. But what if I didn't pay cash, and instead I chose to open a store credit account? Would that entry look any different? Of course it would. It would look like this. Accounts receivable would be debited $2,500. Sales revenue would be credited $2,500. The cost of goods sold would be debited $2,000. And the inventory would be credited $2,000. Do you see the difference in the two entries? Both entries resulted in increases in the balances in the sales revenue and cost of goods sold account, as well as a decrease in the balance of the inventory account. However, the cash sale resulted in an immediate increase in the cash account balance, while the credit sale results in a temporary increase in the accounts receivable account balance. As payments are received on a customer's credit account, the balance in the cash account increases, and the balance in the accounts receivable account decreases. The furniture that I purchased was bought on credit. The terms require that I pay $208.33 a month for a period of 12 months. The entries to record those payments would look like this. Cash would be debited $208.33 and accounts receivable would be credited $208.33. In order for a business to make money, it must make sales. Sales are the transfer of ownership of goods between a merchant and a customer for money. There are two types of sales. Cash sales are sales that are made where payment is received immediately. Credit sales, that are sales on account, are sales made on specific terms, with payment being expected to the store at a later date. Regardless of the types of sales, there are a few things that must be considered when calculating the amount of a sale. Sales discounts, which may be offered to customers who have store credit accounts, are discounts that are offered to customers by a business in exchange for paying their bill within a given time frame. Sales returns and allowances are either merchandise that has been returned by a customer or allowances given to a customer because of defective merchandise. The cost of goods sold is the dollar value associated with inventory items that have been sold. Each of these three things are deducted from the sale price paid on an item and reduces the bottom line profit from a sale. Each and every sale that's made must be recorded in the accounting records of the company. For inventory sales, 2 entries are made for each sale. The first entry records the actual sales transaction. For cash sales, the first entry requires a debit to the cash account for the actual sales amount and a credit to a revenue account in the same amount. For a credit sale, the first entry requires a debit to the accounts receivable account and a credit to the revenue account in the amount of the sale. Both types of sales have the same second entry per transaction. That entry requires a debit to be made to the cost of goods sold account in the amount that the merchandise was purchased by the company and a credit to the inventory account in the same amount. Once the entries have been made and the sale accounted for, then and only then will it accurately be reflected in the financial statements of the company. After this lesson is done, you should be able to define sales and identify the 2 types of sales. Describe the 3 considerations that must be made before calculating the sale amount. Explain how a sale is accounted for in a company's accounting records.
Bentley has just started working at the local clothing store. A customer stops by to purchase a pair of jeans. Bentley rings up her purchase, collects her payment, and bags her purchase. He's made his first sale. Little does he know, but that sale has kicked off a chain of events that must occur in order for it to be reflected in the store's accounting records. It's called recording sales. Recording sales means to enter information about sales revenue into the accounting records so that it reflects accurate balances in affected accounts. Before sales can be recorded, the company has to have decided what type of inventory system to use, periodic or perpetual. A periodic system is one where inventory is updated at specific points in time, usually only once in an accounting period. A perpetual system is one where inventory is updated after every single transaction. For the purpose of this lesson, we're going to assume that the clothing store uses the perpetual inventory system. Now let's analyze and record the sales transaction that Bentley just made. There are 3 specific things that we need to know to record this transaction: the selling price, the purchase price of the inventory, and the accounts affected. The selling price is the price that a customer pays for merchandise. In this transaction, we'll say that the selling price of the jeans was $40. The purchase price is the price that the company pays for merchandise inventory. This amount includes any costs that are associated with the purchase of the goods, including shipping, receiving, and storage costs. The purchase price of the jeans was $25. In the perpetual inventory system, a sale requires 2 separate entries in the accounting journal. The first entry will record the actual sale. The type of sale, which is either cash or sale on account, determines the account that will be debited on the first transaction. If the sale is a cash sale, the cash account is debited. If the sale is a sale on account, which is a sale that's made where cash is received at a later date, the accounts receivable account is the account that will be debited. Regardless of the type of sale that occurred, the account that will be credited is the sales revenue, which sometimes is just called revenue. The second entry will take the merchandise that was sold out of the store inventory. Now, in order to do this, the cost of goods sold account is debited and the inventory account is credited. The amount that's associated with this entry is the purchase price of the item and not the sale price. Since I've given you all the information that you need to record the sale, let's look at what the journal entries will look like for a cash sale. First of all, we put the date. We'll say it's December 1st. So on the first entry, it says December 1st. Cash is the account debited, so it's the account listed first, and $40 is debited to cash. On the next line, sales revenue is the account that's credited, and it is credited $40. The second entry again starts with a date, December 1st. The account that's debited is cost of goods sold, but the amount is $25. The account credited is the inventory account. It's credited $25. As you see, these entries together show that the profit made from the sale of the jeans was $15, which is the $40 minus the $25. Now let's look at the same transaction, but instead of it being a cash transaction, it's a sale on account. To record this, once again we have 2 separate journal entries. The first entry says the date, December 1st, followed by the account that is debited, which is in this case accounts receivable, and it is debited $40. The account credited is sales revenue. It's credited $40. The next entry again says the date, December 1st. The account that's debited is cost of goods sold. It's debited for $25. Inventory is the account that's credited, and it's credited for $25. Once again, this entry shows a profit of $15 on the sale of the jeans. In order to maintain harmony in accounting records, every single transaction that occurs must be recorded in the accounting records, and sales are no different. Recording sales means to enter information about sales revenue into the accounting records so that it reflects accurate balances in affected accounts. Before sales can be recorded, the company has to decide what inventory valuation system is to be used. In this lesson, we chose the perpetual system, which is one where inventory is updated after every single transaction. There are 3 things that you have to know in order to record a sale using the perpetual system: the selling price, the purchase price, and the accounts that are affected by the sale. The selling price is the price that a customer pays for merchandise. The purchase price is the price that a company pays for merchandise inventory. The accounts that are affected by the sale is dependent on the type of sale that was made. A cash sale affects the following accounts: cash, sales revenue, cost of goods sold, and inventory. The cash account is debited for the selling price of the item. The sales revenue account is credited for the same amount. The cost of goods sold account is debited for the purchase price of the item, and the inventory account is credited for the same amount. If the sale is a sale on account, then the accounts that are affected are accounts receivable, sales revenue, cost of goods sold, and inventory. The accounts receivable account is debited for the selling price of the item. The sales revenue is credited in the same amount. The cost of goods sold is debited for the purchase price of the item, and the inventory account is credited for the same amount. Once a transaction is recorded in the accounting records, all the affected accounts will have updated balances.
From balance sheets to master budgets, you do it all. Your accounting system has kept managers accountable, suppliers happy, and executives pleased since you first implemented it weeks ago. Simply put, you know where every dollar and every cent is going to and coming from in your organization. At least, that's what the books say. You'd better watch out. A bit too smug of an accounting job, and you may find yourself unable to catch an error that throws everything off. Luckily, there is a solution, and one you should regularly do. By reconciling the bank accounts, you double-check accounting books with respect to the actual bank accounts. In this lesson, we'll learn why it is so important to reconcile bank accounts with spending and earning statements, as well as how to do it. First, let's take a look at some reasons that should explain why it's so important to reconcile your statements. People make mistakes. Whether it is you, a customer, a vendor, or the bank, mistakes happen in business. If you didn't check the accounts, you might not have a way of recognizing that the mistake happened. Bank reconciliation gives you the opportunity to go over the details of your spending again so that you can catch small errors before they become bigger ones. Almost as annoying as errors are bank fees. Banks now make billions of dollars a year off of fees alone and are always looking for a way to sneak new ones in. In fact, some banks even charge for making deposits. As banks may not always send out an invoice whenever a fee occurs, you've got to watch out for these attempts to take more of your money. Finally, there is always the chance that someone has done some unauthorized spending out of the account. While much of this is accidental in nature, such as a vendor charging too much for goods, there can be examples of fraud or theft. As a result, it's wise to make sure that whoever reconciles the accounts is not also the person who handles the routine bookkeeping. That would allow them to cover up fraud easily. So, now that you're convinced of the need to reconcile the books, how do you do it? Before we get too far ahead of ourselves, you should do it at least once a month, or whenever large amounts of money enter or leave your possession. When it comes time to do it, however, you've got 2 choices. If you have a solid suite of accounting software, chances are that the applications will simply do it for you. Give the program access to your bank accounts and the software will analyze your books. On the other hand, if you don't have such software, you'll have to go through your bank statements one at a time and match each expense and each credit up to a known expense or income source. It goes without saying, I hope you saved your receipts. Whichever method you decide on, make sure that you do this for all of your bank accounts. Many companies spread their money through numerous accounts, if not numerous banks. When reconciling the accounts, you need to make sure you examine all of them. That said, there are two other aspects of actually reconciling the accounts that are worth mentioning to save stress later. The first of these is recognize that some items may still be in transit and not reflected in the latest bank account paperwork. In-transit funds are those monies that have not yet been credited by the bank to an account. This is true for individuals too. If you have transferred money from one bank to another, chances are it takes a few days for the transfer to come through. Also, if you've ever written a check only to have the recipient not cash it, you can understand how frustrating this can be when balancing your own checkbook. Further, you must also be aware of smaller changes to the account. Earlier, we talked about the bank sneaking fees, but what if the bank suddenly paid interest for money you had left in the account? That would be enough to throw off your numbers. By reconciling the bank account, you have the chance to look for those instances and correct them. Let's review. In this lesson, we looked at the importance of reconciling the bank account. Remember that reconciling the bank accounts involves double-checking accounting books with respect to the actual bank accounts. This helps us make sure that we not only avoid accounting errors, but that the bank wasn't issuing unknown fees and that there was no unauthorized activity on the accounts. Luckily, with most modern accounting software, the process is as simple as giving the application permission to look at your bank accounts. However, it can be much more mundane without it. In any event, bear in mind that those monies that have not yet been credited by the bank to an account or in transit can have an effect on the bottom line.
Can you count? If you answered yes, then guess what? You have already mastered the biggest part of taking a physical inventory count. The first thing that I need to do is to explain to you exactly what I'm talking about when I use the term inventory. Inventory is the items on hand that are considered assets to a business and are used to bring in income. Taking inventory really is a time-consuming job, so why do it? Is it really that important? It most certainly is. Inventory is an asset. An asset is something that a company owns that has value and can be used to create revenue. If the amount of inventory that a company has is incorrect, then the total amount of assets that the company has will also be incorrect, as will the total amount of income that a company reports on its financial statements. Inventory that is overstated, meaning that the amount of inventory reported is more than what is actually on hand, results in net income being overstated. Net income is the amount of money that a company made in a given time period after all expenses have been deducted. If net income is overstated, then it looks like the company made more money than it actually did. On the other hand, if inventory is understated, meaning that the amount of inventory that is reported is less than what is actually on hand, then the net income is also understated. This means that it looks like the company makes less money than it actually did. In order to ensure accuracy in inventory, a physical count of the inventory must be taken. Planning is the number one key to success when it comes to taking inventory. But what exactly do you plan for? A number of things. The first thing to do when preparing for an inventory count is to make sure to preview inventory or to look over reports of what is supposed to be in inventory. Most companies have an automated inventory system that allows for users to see what the company says is in inventory. Even if a company doesn't have an automated system, there are records of what is supposed to be in their inventory. After reviewing what should be in inventory, management should make sure that grouping occurs. Grouping means that all categories of items are grouped together in their appropriate location. For example, in a clothing store, all short-sleeve shirts should be grouped together by maker, size, and color. The same is true for any other items carried by the store. Doing this before the actual process of inventory counting helps to ensure that everything is counted as accurately as possible. Once this is done, it's time to create counting teams and counting lists. Counting teams are those individuals who will be counting specified items, while counting lists are the items that will be counted. Knowing who is counting what allows management to track accountability of the numbers turned in and keeps counters from performing redundant counts on the same items. It also allows members of the accounting team to know what they are supposed to count. Another important step in the inventory counting process is to be sure to halt data entry. This means that all transactions involving inventory are halted during the inventory process. What do I mean by that? Well, if you're going to count inventory on a specific date, and that count is compared to what is believed to be an inventory on that date, then there does not need to be any inventory adjustments made. Inventory adjustments are additions or subtractions to inventory. By this point, the planning stage is complete and the actual physical count of inventory can commence. So how exactly does misstating inventory cause net income to be wrong? Well, in order to calculate net income, there are several variables that are considered. The basic formula states that net income equals sales minus cost of goods sold minus operating expenses plus other revenue minus other expenses. The component of the formula that we're going to focus on for this lesson is the cost of goods sold, the dollar amount that items sold during a specific time period to generate revenue cost the company. This amount could be calculated by using the total cost of each specific item sold, but that would be a time-consuming project. Instead, the amount is figured by adding the total cost of new purchases to the reported value of beginning inventory and subtracting the ending inventory value reported at the end of the period. If the inventory value reported is wrong, then the cost of goods sold value will be wrong, which will make the net income wrong. Inventory is the items on hand that are considered assets to a business and are used to bring in income. There are 5 basic steps in the planning process. Previewing inventory means to look over reports of what is supposed to be in inventory. Grouping inventory means that all categories of items are grouped together in the appropriate location. Counting teams are those employees who will be counting specific items. Halting data entry means that all transactions involving inventory are halted during the inventory process. Inventory adjustments, which are additions or subtractions to inventory, ensures that the inventory on the counting list are accurate as possible. Overstated inventory, meaning that the amount of inventory reported is more than what is actually on hand, as well as understated inventory, meaning that the amount of inventory reported is less than what is actually on hand, both have effects on the net income of a business.
Mega Irrigation, a large irrigation wholesale store, is looking to switch from a periodic inventory system, where they update financial records for merchandise transactions at the end of a period, to a perpetual inventory system, which will allow them to continually update records for merchandise transactions. Management at Mega Irrigation believes that this will allow them to keep more accurate and up-to-date records of their inventory that is available to be sold to their customers, and what specific inventory has already been purchased. The perpetual system will tell Mega Irrigation the exact amount of inventory on hand at all times, and what they need to restock to meet customer demand. Perhaps the most significant goal of accounting for inventory is to have an accurate assessment of costs and sales. Inventory valuation allows a company to provide a monetary value for items that they have in their inventory. This information permits a company to properly evaluate expenses and revenues on their financial statements so that they can make sound business decisions. Items contained with Mega Irrigation are constantly being sold, restocked, and in some cases changing in cost. Because of all these changes, Mega Irrigation must select a cost flow assumption method to move the cost of items within its inventory to its costs of goods sold. The cost of goods sold refers to the cost of merchandise sold during a specific period of time. Cost flow assumptions under a perpetual inventory system include specific identification, first in, first out, last in, first out, and weighted average. Once implemented, Mega Irrigation must consistently follow its stated cost flow assumption. Let's take a look at each of these cost flow assumptions a bit more to help Mega Irrigation choose one that is best suited for their needs. Specific identification is used to track and cost specific and identifiable inventory items that are either in or out of stock on an individual basis. This is done with items a company has identified via RFID tag, stamped receipt date, or serial number. The system is designed to specifically allow Mega Irrigation to identify the cost of any inventory item with an ID number. The best advantage with this method is the high level of accuracy to the cost of the inventory on the balance sheet. The disadvantage of this system is the time it takes to enter large quantities of inventory and their prices. Specific identification is typically a practical solution for companies with expensive and unique inventory. This is not the case for Mega Irrigation. Therefore, we will jump to the next cost flow assumption method, known as FIFO. FIFO is a contraction for first in, first out, and means that the oldest inventory items are recorded as sold first. Essentially, FIFO assumes that inventory items are sold in the order in which they are acquired. Inventory items bought first are the first ones to be sold, and inventory items bought later are sold later. Thus, the cost of inventory reflected to the balance sheet represents the cost of inventory that was purchased most recently. As an example, let's say that Mega Irrigation has purchased 10 sprinklers at $10 and 20 sprinklers at $20. At the end of the accounting period, the irrigation wholesale sells 5 sprinklers at $10. Remaining inventory is 5 sprinklers at $10 plus 20 sprinklers at $20 for a total remaining on the balance sheet of $450. FIFO is used by many companies, but is most useful when inventory items have a short shelf life or expiration date and need to be sold quickly, such as in the food industries. Because irrigation parts have a long shelf life, we can move on to the next method, known as LIFO. LIFO is a contraction for last in, first out, and assumes that the most recent inventory items purchased are the first ones to be sold, and inventory items purchased first are sold last. As a result, LIFO comes closest to matching current costs of goods sold with revenues when compared to other cost flow assumption methods, such as FIFO or weighted average. Using the same example as FIFO, let's look at it using the LIFO method. Remember, Mega Irrigation had purchased 10 sprinklers for $10 and then 20 sprinklers for $20. At the end of the accounting period, Mega Irrigation has sold 5 sprinklers at $20. Remaining inventory will look like this when using the LIFO method. 15 sprinklers at $20 plus 10 sprinklers at $10. The balance sheet will show $400. This method is generally used because it helps to reduce income tax. A little interesting fact is that the United States of America is the only place you can legally use the LIFO accounting method. The final cost assumption method for Mega Irrigation to consider is the weighted average. The weighted average method, also known as average cost, involves computing the weighted average cost per unit of inventory sold at the time of sale. It assumes that inventories are sold simultaneously. The weighted average method is useful in companies where inventory items are piled or combined together in such a way that they cannot be separated to assign a specific cost to the individual units within it. It is also a good alternative when a company's accounting system lacks the sophistication needed to track inventory items under the LIFO and FIFO methods. To calculate using the weighted average method, divide the total cost of items in inventory available for sale by the total number of units available for sale. Let's look at our example. Again, Mega Irrigation had purchased 10 sprinklers for $10 and then 20 sprinklers for $20. At the end of the accounting period, they had sold 5 sprinklers. The total number of sprinklers is 30 for a cost of $500. To calculate the ending inventory balance using weighted average, start by dividing the total cost by total number of sprinklers. In this case, it is $500 divided by 30 sprinklers, equaling $16.67 per sprinkler. The remaining inventory is 25 at $16.67, which is $416.67 in remaining inventory on the balance sheet. Let's review. Perhaps the most significant goal of accounting for inventory is to have an accurate assessment of costs and sales. Inventory valuation allows a company to provide a monetary value for items that they have in their inventory. The perpetual inventory system allows a company to continually update records for merchandise transactions. Inventory items constantly being sold, restocked, and in some cases changing in cost. Therefore, it is essential for companies such as Mega Irrigation to track the cost of goods sold, which refers to the cost of merchandise sold during a specific period of time. Cost flow assumptions under a perpetual inventory system include specific identification, first in, first out, last in, first out, and weighted average. Specific identification is used to track and cost specific and identifiable inventory items that are either in or out of stock on an individual basis. It allows companies to relieve inventory for the specific cost associated with an item when it's sold. The best advantage with this method is the high level of accuracy to the cost of the inventory on the balance sheet. FIFO is a contraction for first in, first out, and means that the oldest inventory items are recorded as sold first. Essentially, first in, first out assumes that inventory items are sold in the order in which they are acquired. Inventory items bought first are the first ones to be sold, and inventory items bought later are sold later. Thus, the cost of inventory reflected to the balance sheet represents the cost of inventory that was purchased most recently. LIFO is a contraction for last in, first out, and assumes that the most recent inventory items purchased are the first ones to be sold, and inventory items purchased first are sold last. As a result, LIFO comes closest to matching current costs of goods sold with revenues when compared to other cost flow assumption methods, such as FIFO or weighted average. The weighted average method, also known as average cost, involves computing the weighted average cost per unit of inventory sold at the time of sale. It assumes that inventories are sold simultaneously. With the various perpetual inventory evaluation methods available, it is important to determine what method best suits a company's needs. Once Mega Irrigation decides to implement the one that works best for them, they will have a key piece of information to help them make the best business decisions moving forward.
If you run your own company, then you will need to prepare regular financial statements so you can see how your business is doing financially. Your financial statements are also required for your taxes. We define financial statements as written records that show individual business activities and how the company is performing. If you're doing your yearly taxes, then your financial statements are those that show your purchases and expenses for the tax year. Now, how much profit you show on your financial statement can actually be different depending on the type of costing method you choose to evaluate the cost of your inventory. We define costing method as the method to determine the cost of your inventory. In this lesson, we'll look at the 3 different costing methods along with their impact on your financial statement. Pretend that you're the owner of a shop specializing in fancy dishes. Your inventory consists of lots of fancy dishes. Let's see how the different costing methods can change how much profit you show on your financial statement. The first method is FIFO, or first in, first out. With this method, you price inventory according to the oldest purchase. So if you received inventory on Monday for $10 each, Tuesday for $12 each, and Wednesday for $13 each, this method assumes that the inventory you received on Monday will sell before the inventory on Tuesday. Your inventory cost will go from $10 to $12 to $13 as you sell your items from oldest to newest. Grocery stores generally use this costing method as older items are sold before the newer items. This prevents food products from expiring before being sold. This method can actually increase the profit you show on your financial statement. How so? Well, this method does not take into account inflation. Think about it. Say you purchased some sets of fancy dishes for $20 per set last year. This year, that same set of dishes is now worth $25 each. Using the FIFO method, though, you would show that your inventory still costs $20 per set. Your profit will look higher. For example, if you sell your dishes for $40 per set, at the current value of $25 per set, you'll make a profit of $40 minus $25, which equals $15. But on your financial statement, you show a profit of $40 minus $20, which equals $20, since you're using the value of the dishes from last year when you purchased them. The second costing method is LIFO, or last in, first out. With this method, your inventory is priced according to the most recent inventory purchase. So using the same example of receiving inventory on Monday for $10 each, Tuesday for $12 each, and Wednesday for $13 each, this method will have your inventory costing $13, $12, and then $10 as you sell your products from newest to oldest. Some companies prefer the LIFO method because it provides for more tax benefits. The tax benefits come from using the most recent inventory cost instead of the oldest cost. Because of inflation, you will actually show a smaller profit on your financial statement, since your latest inventory cost will usually be higher than the inventory cost of your older inventory. Using the same dishes example, say you purchased your dish sets for $20 last year. This year they're worth $25. Using the LIFO method, you note down the cost of your inventory as $25 per set. Selling them for $40, you note that you get a profit of $40 minus $25, which equals $15 per dish set on your financial statement. In reality, though, you get a profit of $40 minus $20, which equals $20, since you only paid $20 for the dishes last year. The third method is the weighted average method. This method calculates the average cost of each of your products. It divides the total you paid for your inventory by the number of items purchased. This method will give you an inventory cost that is more aligned to inflation, since it includes prices before and after inflation. How does this impact your financial statement? During times of inflation, your average cost per product will be higher, thus decreasing the profit you show on your financial statement. Let's review. Financial statements are written records that show the individual business activities and how the company is performing. When it comes to deciding how much your inventory costs you, there are 3 different costing methods. We define costing method as the method to determine the cost of your inventory. Here is a summary of the 3 methods and how each impacts your financial statement.
Imagine for a second that you are running a business, trying to figure out how much of what goods you have in stock. Your warehouse manager still uses handwritten records, and you can't quite make out the difference between 180,000 and 100,000 units. Either way, you're at risk of having an inventory error, a situation that emerges when what you think you have in inventory doesn't match up with what's actually there. As you can imagine, these are particularly devastating to businesses. In this lesson, we'll look at 2 major types of inventory errors, namely overstatements and understatements, as well as learning what the impact of an inventory error is on an income statement and a balance sheet. Before we go any further, let's take a look at some of the most common causes for inventory errors. As you can imagine, there are plenty. First of all, you could have simply miscounted. Now, that's not as simple as it sounds, as in addition to sheer error, there could also be the chance that some units were double counted or simply ignored. Think about it like this. If you have a client who doesn't always pick up their orders on time, then they may end up having their goods counted in your inventory. Other causes for errors exist, many of which are much more mundane. Chances are you've had to convert between different units, such as pounds to kilograms or gallons to liters. Many organizations have different units for counting different goods. A pallet, for example, may be used to count some goods, but not others. As a result, someone could count pallets when they really should have counted tons. Of the 2 categories of inventory errors, perhaps the most dangerous to a business is one that results in overstated profits, where the inventory report states that the company should have made more money than it actually did. These overstated inventory reports can come about in a variety of ways, all of which are in turn errors within inventory. Let's say that you underestimated the number of goods you started with. Because of this underestimation of beginning goods, you think you bought less units than you actually did, leading to an overstatement of profits. By the same token, thinking that you processed more goods over the course of a term could also lead to an inventory error, as you think you've had more and more goods move through inventory. As a result, you again end up with an overstated profit. Let's look at an example. Remember this formula. Beginning inventory plus purchases equals end inventory plus cost of goods sold, COGS. You plug in the inventory numbers and purchases and calculate the cost of goods sold. If our beginning inventory is too low by $5,000, your COGS will also be too low by $5,000 when you're done. That will result in profits being overstated by $5,000. While overstated profits are horrible, understated profits are also particularly bad. After all, if you can't keep track of your money, then you're likely very inefficient in other aspects of the business as well. As you might expect, many of these problems are the inverse of the overstated issues from earlier. For example, if you think you have more goods than you actually have at the beginning of a sales term, you may think that fewer goods have moved through the whole process. That leads to an understatement of profits. Likewise, thinking that you have more goods in stock after a sales period could also lead you to think that you sold less than you did, leading to understated profits. Here's another example. Suppose your end inventory is understated by $5,000 because a warehouse was missed. That will result in COGS being overstated by $5,000 and profits to be understated by $5,000. Once an inventory error has been discovered, it has to be corrected on the income statement. If not, the balance sheet. Many of these errors end up being found on the income statement, and notation must be made to address the error as quickly as possible. Otherwise, as you'd expect, the error becomes the first in a series of dominoes that require later attention. The good news is, however, that if the owner of the goods in question accurately finds the error and adjusts it on other forms, no notation needs to be made on the balance sheet for that accounting period. Of course, if the error is not found, then the assets will still be shown as either overstated or understated. In this lesson, we looked at the importance of tackling inventory errors. We started by looking at causes of inventory errors, from counts that went wrong to different standards of measurement. We then looked at the impact of overstatements and understatements, as well as how each could develop. From there, we saw the impact of inventory errors on standard accounting practice, namely with respect to income statements and balance sheets.
Bo owns a retail store that caters to hunters and fishermen. He always tries to keep the store stocked with the most up-to-date hunting and fishing equipment that there is out there. Running out of something just isn't an option in his book. That idea may be a good thing, but in the end it also means that he carries quite a bit of inventory that must be valued at the end of an accounting period. Do you know how inventory is valued? It may surprise you to know that it isn't valued at the wholesale or retail cost. It's valued based on something called the net realizable value. The net realizable value, also known as NRV, is the return that you would expect to get on an item after the item has been sold and the cost of selling that item has been subtracted. Calculating NRV is fairly simple. You simply take the selling price of an item and you subtract any costs that you incurred getting that item ready for sale. So let's look at an example. Bo has deep sea fishing rods that he plans to sell for $120. It's going to cost him $4 to package the rods to get them ready to be sold. Since NRV equals selling price minus selling cost, then NRV equals $120 minus $4. So the NRV of the deep sea fishing rods is $116. One very important thing that you must realize at this point, though, is that NRV and profit are not the same. We've already said that NRV is the selling price of an item minus any cost associated with selling that item. Profit is the amount of money that's made in excess of the purchase cost of an item. Do you see the difference? The NRV is based on selling price and profit is based on purchase price. So let's look at another example to clarify this concept. I have a car lot. I purchased a car for $12,000 and plan to resell that car for $16,000. It's going to cost me $250 to get the car ready for sale, and the commission that the employee who sells the car will make is $400. So what is the NRV of this car? To answer this question, I need to know two things: the selling price and selling cost. The selling price is $16,000. The costs that are associated with the sale are $250 plus $400, which equals $650. Now I need to subtract the cost from the sales price. So $16,000 minus $650 equals $15,350. Now that you know what NRV is and how to calculate it, let's talk about why it's so important. Any business that carries any kind of inventory has to value that inventory. The manner in which inventory is valued is specified by the generally accepted accounting principles, which are also known as GAAP. GAAP are the guidelines for financial reporting and recording, and they're established by the Financial Accounting Standards Board. GAAP requires that inventory be valued at the lower of cost or market. The lower of cost or market, LCM, means that inventory is valued at the lower of the total cost of purchasing the material or the current market replacement cost. As the definition states, cost is the total price of purchasing an item. Market is the replacement cost. So here's where NRV comes into play. When determining the market price for LCM, there are certain restrictions that apply. The market price can't be higher than the market ceiling nor lower than the market floor. The market ceiling of a product is the NRV. The market floor is the NRV minus the normal profit that is expected to be received from the sale of the inventory item. So if the market price of an item falls between these two figures, then it's deemed an acceptable price. If the market price is above the ceiling, then the price to be used for the LCM comparison is the NRV. If the market price is below the NRV, then the market floor is the price used for the comparison. I know that's a lot of information to try to absorb, so we're going to use an example to help you out. Look back at Bo and the deep sea fishing rod and reels. The rod and reels cost Bo a total of $78 each, but he sells those for $120 each. The total profit that Bo expects to make off of each rod and reel is $42. The current market replacement cost for the rod and reels is $118. The NRV of the rod and reels is $116. So what are the prices that Bo will use when trying to decide the lower of cost or market? First, we know that the price that is associated with cost will be $78. The current market price is $118. However, is this the market price that should be used for comparison? At this point, we don't know. We're going to have to figure the market ceiling and the market floor. The market ceiling is the same as the NRV, which is $116. The market floor is the NRV minus expected profit. So to figure that, we would take the NRV of $116 and subtract the $42 that Bo expects to make off of each rod and reel. That makes the market floor be equal to $74. Now to decide which market value to use. The current market price is $118. We know that the market value can't be more than the market ceiling or less than the market floor. In this case, the market price is more than the market ceiling. So because of that, the value that we must use for the market is $116. The cost of each rod and reel is $78. The market of each rod and reel is $116. Since we're looking for the lower of cost or market price to use when valuing the inventory, then the price we'll use for the rod and reels is the cost of $78. Now what would happen if the market price of the rod and reels had tumbled? Let's say the current market price is $70. What would be the value used in the LCM then? Well, since we already know that the NRV of the rod and reels is $116 each, and we also know that the market ceiling is the same as the NRV, and the market floor is $74, well, since the current market price is lower than the market floor, we would have to use the market floor price of $74 to value the inventory. But what if the market price was $75? Well, in this case, since the current market price falls between the market ceiling and the market floor, then that price is acceptable and can be used in the comparison. Valuing on-hand inventory is not as easy as some may think. Inventory items can't be valued at their sales price. There has to be a few calculations done to come up with the correct dollar amount to assign to inventory. One of those calculations is to find out what the net realizable value of an item is. The net realizable value is the return that you would expect to get on an item after the item has been sold and the cost of selling that item has been subtracted. The NRV, as it is also known, is calculated by subtracting any expenses that were incurred getting an item ready for sale from the sales price. But why is it so important to know? Because GAAP principles require that inventory be valued at the lowest price possible. And since GAAP, also known as Generally Accepted Accounting Principles, are the guidelines for financial reporting and recording, then what they say goes. The concept that follows the GAAP guidelines for inventory valuation is known as the lower of cost or market, where inventory is valued at the lower of the total cost of purchasing the material or the current market replacement cost. Cost is the total price of purchasing an item. Market is the replacement cost of an item. It's in the calculation of the market price that NRV plays a part. There are limitations on what market price can be. The market ceiling or the top price is the same as the NRV. The market floor or lowest price is the NRV minus the normal profit that's expected to be received from the sale of the inventory item. If the current market price is higher than the market ceiling, the rule is that the market ceiling price is the one that's to be used for inventory valuation purposes. If the price is lower than the market floor, then the market floor price is the one that should be used. If the price falls between the ceiling and the floor, then the current market price should be used. Once the decision over which market price is the one that is to be used is compared to the price that is associated with cost, and the lower of the two prices is the one that's used to calculate inventory value. I love to shop, and I'm a sucker for a sale. There's just nothing better than going shopping and coming home with things that I've purchased for less than half of their original price. And having racks and racks of choices, well, that's just icing on the cake. But sometimes the accounting fanatic comes out in me, and I find myself wondering what the value is of all the inventory in my favorite stores. I know that generally accepted accounting principles, or GAAP for short, which are the guidelines for financial recording and reporting, require that on-hand inventory at the end of an accounting period be valued at the lowest value possible. But how's that done? And what exactly is inventory valuation anyway? Inventory valuation is the total dollar amount that is attributed to the inventory on hand. Though there are 3 GAAP-approved ways to value inventory, in this lesson we're going to discuss one of those, the lower of cost or market. The lower of cost or market, which is also known as LCM, is the inventory valuation method that records inventory value as the lower of cost or market. And that seems simple enough, doesn't it? Well, now let's break it down into the two components, cost and market. Cost is the acquisition price of inventory. Now notice that I didn't just say it was the purchase price of the inventory, because it isn't. Cost in this case is the sum of the purchase price, shipping cost, storage cost, and any other costs that are directly associated with the inventory item. It can be a little confusing, so let's look at a quick example. I own a retail store. I purchased 50 scarves to sell in my store. I paid the supplier $150 for the scarves. Shipping costs were $18. Storage costs for keeping the scarves in inventory and ready for sale were $13. So the total cost of the scarves that would be used for inventory value would be $181, or $3.62 per scarf. Market, which is the other part of this concept, is a bit more complex. Market is defined as the amount that would have to be paid to replace a unit of inventory with an identical product. Market has limits on the amount that it can be. The upper limit, which is called the ceiling, is the net realizable value of the inventory. The net realizable value is the sales price of an item minus the selling cost associated with that item. The lower limit, which is called the floor, is the net realizable value minus the expected profit of the item. Now I know that's quite a few terms, so let's look at another example to bring this concept into perspective. Remember the scarves that I purchased to sell in my store? I paid $3 per scarf when they were purchased. The current replacement cost of each scarf is $2.80. I'm selling the scarves for $7 each. I expect to incur $2.50 in selling expenses per scarf. Using these numbers, it's easy to see that the NRV per scarf is $4.50. Since the ceiling is equal to the NRV, then the market ceiling is $4.50. Now the market floor is the NRV minus the expected profit per item. The expected profit per scarf is $4.20. That's the $7 that I'm selling the scarves for, minus $2.80, which is the replacement cost of each scarf. Since the NRV is $4.50, we can see that the market floor is 30 cents. Since the replacement cost of each scarf is $2.80, and that price falls well between the market ceiling and floor, then it's an acceptable market price to use for comparison. Now let's see which price inventory would be valued at. We're looking for the lower of cost or market. The total cost for each scarf that we have calculated is $3.62. The market price is $2.80. Since the market price is lower than cost, the scars would be valued at $2.80 each. If there were 18 scars left in inventory at the time that their value needs to be recorded in the accounting records, then the total dollar amount recorded would be 18 scars times $2.80 equals $50.40. All inventory has value that must be recorded in a company's accounting records based on GAAP principles. GAAP are the guidelines for financial reporting and recording. They require that on-hand inventory at the end of an accounting period be valued at the lowest value possible. Inventory valuation is the total dollar amount that is attributed to the inventory on hand. One way to do this is to use the lower of cost or market concept. The lower of cost or market is the inventory valuation method that records inventory value as the lower of cost or market. Cost is the acquisition price of inventory. Acquisition price is the sum of the purchase price, shipping cost, storage cost, and any other costs that are directly associated with the inventory item. Market is the amount that would have to be paid to replace a unit of inventory with an identical product. In order to determine whether the cost or the market value is the amount recorded in the accounting books, both of these amounts are calculated, and the lesser amount is the amount that is assigned as the inventory value.
Billy owns a company that makes screen protector sheets for phones and tablets. He has employees that work to design the best sheets possible, a factory that makes the sheets, and people who sell them to the stores. That's a lot of employees. Billy needs to make sure that all of his employees are compensated and that he still has a profit, but he's not sure how to account for employee compensation in his books. Does he just stick all their salaries in a line in his budget? What about their sick days or bonuses? An employee's salary or wages plus benefits is his or her total compensation. Benefits might include things like sick days, a retirement account, insurance, bonuses, and more. Let's look at how Billy and other business owners can account for employee compensation, starting with payroll. As we've seen, Billy has a lot of employees that are doing different jobs, from design to manufacturing to marketing and sales. How does he account for each employee on his payroll? One way to separate out employee compensation, including salary, is by grouping the employees into two groups, direct and indirect. Direct employees are involved directly in the creation of the company's product. For example, Billy has lots of people who work at his factory to make his screen protectors. The people who are on the assembly line, the ones who actually touch the product, are direct employees. On the other hand, indirect employees support product development and manufacture indirectly. That is, they don't actually touch the end product. The engineers at Billy's company that design the screen protectors and the salespeople who sell them are indirect employees. They help support the product indirectly. In payroll and accounting, many companies choose to put the salaries or wages of the direct employees on one line and the salaries or wages of indirect employees on another. This is because in many companies, the pay of indirect employees is filed under overhead expenses, or those that keep the business running but are not directly related to the manufacture of the product. Billy understands how to account for the salaries and wages of both direct and indirect employees at his company. But as we've seen, what shows up on their paycheck isn't the only compensation they receive. From health insurance premiums to paid vacation and sick days, there's a lot more that employees can cost Billy. When it comes to benefits like sick days or insurance, and bonuses, Billy will want to account for the cost of the benefit when it is earned, not when it is paid. For example, if one of Billy's employees earns one sick day for every 3 months they work, he will want to account for the cost of that sick day every quarter, even if the employee doesn't take the sick day during that quarter. The same is true of bonuses. Billy pays his salespeople a bonus of 5% of their sales every year. At the end of the year, they get a check for the amount of 5% of everything they sold. But they are selling things all year long, so Billy will want to account for that 5% for every sale that is made all year long, not just at the end of the year when he writes the checks. In addition to the salary and benefits that an employee receives, Billy is also responsible for certain taxes such as the employee contributions to Social Security and Medicare and unemployment taxes. Again, Billy will want to account for these every paycheck and include them in his accounting. Compensation includes the wages and benefits that an employee receives for their work. When it comes to accounting for employee salaries and wages, many companies distinguish between direct employees, who are involved in the manufacture of a product, and indirect employees, who are involved in non-manufacturing support positions within the company. Indirect employee salaries are often grouped with overhead expenses when accounting. In addition, benefits, bonuses, and taxes should all be accounted for when they are earned, not when they are paid out. They say the only things that are guaranteed in life are death and taxes. Leslie knows that. She owns her own business, a small flower shop, and it seems like she's always paying taxes. Taxes are a required payment to the government. Individuals like Leslie or you or me have to pay certain taxes every year, but so do businesses like Leslie's flower shop. The taxes a business pays partly depends on where it is located and partly depends on what type of business it is. Let's look at how Leslie can account for 3 common taxes businesses face: sales tax, income tax, and property tax. Have you ever gone to the store to buy something that was $20, but when the clerk rang it up it was more than that, like $21.50? The extra money that you had to pay was a sales tax, or a tax levied by the government on things that are purchased. In the United States, sales taxes vary from state to state, but the business is always responsible for collecting the sales tax and passing it on to the government. In Leslie's state, the sales tax is 7% on every purchase. So let's say that a man comes into the store and buys $100 worth of flowers for his girlfriend. He would actually have to pay $107. $100 for the flowers, and $7 in sales tax. That's pretty simple from his point of view, but how does Leslie record the sales tax? In her books, Leslie will want to record $100 as a sale and then $7 as a liability. In this case, Leslie will be a holding agent for the state, and when she collects that $7 in sales taxes, it creates a liability, something she owes, to the state government. Every April, Leslie gets stressed out because she has to fill out her tax form and pay her taxes. Just like you and me, Leslie's business owes income tax, or a tax levied by the government on the money earned in the previous year. Depending on what type of business it is, income tax varies, but most businesses, including Leslie's, owe income tax to the federal government, the state government, and sometimes to the municipal or city government. That's a lot of tax. Taxes for businesses are slightly different from taxes for employees. An employee has a certain amount withheld from their paycheck every time they get paid, which then goes to the government. But businesses have to file estimated taxes, or taxes paid during the year that are an estimate of the total tax bill for the year. Estimated taxes have to be paid 4 times a year. How can Leslie do this? Let's look at an example. At the beginning of April, Leslie will want to see what her business has earned in January, February, and March. From there, she'll have to estimate what her taxes will be, and then pay the estimated taxes. She'll do this 3 other times during the year, and then the following April, she'll calculate her actual tax owed based on what the business earned. If it's more than what she's paid, she'll have to pay the difference. If it's less than what she's paid, the business will get a refund. Leslie gets that her flower store has to pay sales tax and income tax, but does she also owe money from the building where her flower shop is located? If a business owns real estate, such as a building, warehouse, or land, the business almost always owes property tax, or a tax levied by a municipality and/or state based on the value of real estate. Property taxes are charged on all types of real estate, including personal homes. For example, Leslie owns the house she lives in, and so she has to pay property taxes every year on that. Property taxes for businesses are similar. If a piece of real estate is owned by a business, like the building where Leslie's shop is, then the business has to pay property taxes every year. The way property taxes are assessed, as well as the amount, varies by location. Some states and cities charge property taxes quarterly, some once a year. Leslie will want to do research to find out how her state and municipality charges taxes. Taxes are a required payment to the government. Among other taxes, businesses have to deal with sales taxes, income taxes, and property taxes. A sales tax is a tax levied by the government on things that are purchased. Businesses should collect the sales tax from customers when they purchase goods and record it as a liability in the business accounts. Businesses also have to pay income tax, or a tax levied by the government on the money earned in the previous year. 4 times a year, businesses have to pay estimated taxes, or taxes paid during the year that are an estimate of the total income tax bill for that year. Finally, if the business owns any real estate, it will owe a property tax, or a tax levied by a municipality and/or state based on the value of real estate. Property taxes vary according to state and municipality, so business owners should check the law where they live. Kelly is an accountant at a big company. She takes care of all their bookkeeping and makes sure that they pay their taxes. But she has a question. Her company used to produce a lot of hazardous waste, which they cleaned up, but there is some cleanup that they still have to do. How does Kelly account for the cost of the cleanup that hasn't been done yet? A contingency in accounting is something that is likely to happen in the future that could affect a company's profits. For example, the cost of cleaning up the hazardous waste is likely to happen in the future, and because it will cost money, it will hurt the bottom line of Kelly's company. To help Kelly figure out how to account for the hazardous waste cleanup, let's look at the 2 main types of contingencies: gain contingencies and liability contingencies. Kelly understands that contingencies are the things that might happen in the future that could affect her company's bottom line. But she's heard that there are 2 types of contingencies, and she isn't sure what they are. The first major type of contingency is gain contingencies, or things likely to happen in the future that will affect the bottom line of the business in a positive way. That is, gain contingencies have the ability to make the company more profitable and/or worth more money in the future. The company stands to gain from them, so they are called gain contingencies. For example, when going through the books for her company, Kelly noticed that there's a deduction that she hasn't planned for. This could lead to the company receiving a tax refund. The tax refund is a gain contingency. Other examples of gain contingencies include litigation that could lead the company to being paid a sum of money for damages, possible government contracts or regulations that would be favorable to the company if passed, and certain types of assets that could bring in money if sold. All of these could help the company out, so they are gain contingencies. Kelly should be conservative in her accounting for gain contingencies. In other words, she should only include them in statements if they are pretty much guaranteed to happen, and she knows how much the company will gain. For example, once she knows for sure that the company is going to receive a tax refund, and she knows how much that refund will be, she can enter it into the books even if the refund check hasn't arrived yet. A tax refund sounds great, but Kelly realizes that the cleanup from the hazardous waste is not a gain contingency. It will cost her company money, so it can't be classified as a gain. The second type of contingency is liability contingencies, or things likely to happen in the future that will affect the company's bottom line in a negative way. That is, these things will cost the company money or will potentially lower the profit or value of the company. They are a liability, in other words, which is where the name comes from. Kelly's company cleanup is an example of a liability contingency. It will cost the company money, reducing profits, so it is a liability. Other examples of liability contingencies include litigation against the company and product warranties, among others. One specific type of liability contingency is environmental liabilities, also called environmental contingencies, which is the future cost of the environmental impact of the company. For example, the cost to clean up the hazardous waste from Kelly's company is an environmental liability. With environmental and other liability contingencies, Kelly will want to include them in the balance sheet when she can predict with relative accuracy what the amount of the liability will be. For example, Kelly knows that the hazardous waste cleanup has cost her company an average of $75,000 each year for the past 5 years. So she can put $75,000 in the books as a liability for the following year. Unlike with gain contingencies, Kelly should not wait to include them until she knows for sure that they will happen, only that they are likely to happen. This allows Kelly to keep her accounts conservative. That is, she is estimating her expenses high and her income low, so she's prepared for the worst-case scenario. In accounting, a contingency is an event that is likely to happen in the future that will affect a business's profits and/or value. A gain contingency is an event likely to happen in the future that will increase the business's profits and/or value, while a liability contingency is an event likely to happen in the future that will decrease the business's profits and/or value. A specific type of liability contingency is an environmental liability, also called an environmental contingency, which is the future cost of the environmental impact of the company. When bookkeeping, accountants should only include gain contingencies if they are certain to happen and it is possible to accurately predict the cost of the gain. In contrast, liability contingencies, including environmental contingencies, should be included in statements when they are likely to happen and it is possible to estimate their impact. Judy owns a spa. She has to buy lots of equipment for her spa, as well as things like body lotions, scrubs, and oils. She's heard that doing something called capitalization of her expenses can help make her company more profitable, but she isn't sure what that is or how to do it. Every company has to spend money, whether it's on things like massage tables and robes, like Judy's spa, or raw materials to manufacture cars, or just a computer and internet access. Every company has expenses. To help answer Judy's question, let's look closer at expensing versus capitalizing and when to do each. Judy has a lot of expenses. Every month she has to buy large quantities of lotions, scrubs, and oils. Her spa also offers manicures, so she has to buy nail polish, not to mention office supplies like paper, pens, and printer ink. Expensing an item means calling it an expense and marking it against the profits at the time it is purchased. For example, if Judy makes $100,000 in a month, but spends $40,000 on supplies, then expensing the cost of her supplies would bring down her spa's possible profit to $60,000 for that month. And that's before costs like the wages of the people who work for her. As you can see, expensing items can make a company's profits seem to disappear. Is there a way that Judy could make the profits of her company look better on paper? For some expenses, Judy might choose capitalizing or delineating an item as an asset over expensing. In this case, an asset is something that adds value to a company through the possibility of future value, whereas an expense is just something that costs the company money in an effort to generate revenue. There are two values to capitalizing an expense. First, it can make the company appear more profitable on paper, which is particularly valuable if she wants to borrow money from the bank or sell stock shares in her company. Second, there's more flexibility as far as taxes go. Let's look at the example from above. Judy makes $100,000 but has to spend $40,000. If she expenses the items she purchased, she has to subtract the $40,000 from the $100,000 when she purchases. But let's say that instead she capitalizes the items. She now has $40,000 in assets plus the $100,000 her company earned that month. Together, that's $140,000 on the gain side of the balance sheet in that month. When she subtracts the cost of the items, she ends up with $100,000 instead of $60,000. In addition, Judy can choose to spread the cost of capitalized assets over several months or even years. She can also put the depreciation of assets against her tax bill, potentially saving her company money on taxes. That sounds pretty awesome, right? You might be thinking that Judy should capitalize everything from now on. But wait, not everything is an asset, and there are some things that Judy has to expense, or she risks ending up on the wrong side of regulations and laws. So what can she capitalize and what should be expensed? Anything that is an actual asset to her company and is likely to either appreciate or depreciate in value through the years can be capitalized. A good rule of thumb is to ask how long it will take to use the item up. If it will take a long time, like years, to use the item up, it can likely be capitalized. On the other hand, things that will be used up quickly and don't add actual value to the company need to be expensed. To understand the difference, let's look at an example. As we've seen, Judy has to buy supplies, lotions and printer ink and things like that for her company. When she buys lotion, for example, it doesn't add any real value to her company. It will be used up and then she'll have to buy more lotion. This is something that needs to be expensed. On the other hand, Judy bought a computer for her company. This is an asset because it brings an additional value to the company and will appreciate or depreciate, that is, go up or down in value, in the future. The computer then can be capitalized. So can something like a massage table or pedicure chair. Expensing an item means calling it an expense and marking it against the profits at the time that it is purchased. Capitalizing an item means delineating the item as an asset. There are two values to capitalizing an expense. First, it can make the company appear more profitable on paper. Second, there can be tax benefits to capitalizing. Items that are consumed quickly should be expensed, while items that add value to the company and are consumed over a long period of time, usually years, can be capitalized.
Graham is CEO of a company that's about to go public and sell shares. That's very exciting, but very daunting too. Graham wants the public to pay a lot of money for his company's shares, and he needs to communicate with them about how well the company is doing and what a good investment the company's stocks would be. To do this, he will use an income statement. An income statement is a statement that lists a company's income and expenses for a set period of time. Most companies put out 5 income statements per year, one for each quarter and one for the year. To help Graham put together an income statement, let's look closer at the 2 statement formats and what's included on an income statement. Graham wants to put together an income statement for his company, so he gets several of them to use as examples. But Graham is confused. They look very different from each other. Some of them include things called gross income and operating income, and others just include net income. What's going on? There are 2 major types of income statements, the multi-step income statement and the single-step income statement. A multi-step income statement includes 4 measures of profitability at 4 different places on the statement. These measures of profitability are different types of income. The 4 types of income included on a multi-step income statement are gross income, operating income, pre-tax income, and net or after-tax income. We'll look at each one in a moment, but for now, just know that the multi-step income statements include all 4. In contrast to the multi-step statement, a single-step income statement lists only net income at the bottom of the statement. Both single-step and multi-step income statements include the same basic revenue and expenses, but in a multi-step statement, income is calculated at different points on the statement, whereas in a single-step statement, it is only calculated once. This is where the different types of statements get their names. Income is calculated in different, multiple steps on a multi-step statement, and only one single time on a single-step statement. Of course, if Graham looks at the single-step income statement, he could figure out what the operating income is if he wanted to. All the same information on what's coming in and what's going out is the same, so he just calculated the same way he might calculate it on a multi-step statement. Graham likes the multi-step income statement because it not only breaks down revenue and expenses, but also calculates income at 4 different stages. But he's not quite sure how to make a multi-step income statement. What is included? There are many lines in a multi-step statement. They are: Number 1, net sales. Net sales are all the sales dollars brought in. That is, all the revenue for a company. If Graham's company sold $2 million worth of product last year, he will write $2 million on the net sales line. Number 2, cost of sales. Companies have to make or buy the items that they sell. For example, Graham's company manufactures products. They have to pay for all the materials and equipment used to make the products. For a retail store, the cost of sales includes the price they pay for inventory. Graham's cost of sales is $350,000. Number 3, gross income. Gross income, which is also called gross margin or sometimes gross profit, is the net sales minus the cost of sales. In other words, Graham should take the $2 million from net sales in line 1 and subtract from that the $350,000 cost of sales amount in line 2. The gross margin of Graham's company last year was $1,650,000. Number 4, operational expenses. These are the expenses that are required to keep the company running, such as salaries of employees, utility bills, and other expenses like that. Graham's operational expenses total $250,000. Number 5, operating income. After gross income, operating income is the second of the 4 incomes included on the multi-step income statement. Operating income is calculated by subtracting operational expenses from the gross margins. Operating income is sometimes also referred to as EBIT or EBIT, earnings before interest and taxes. Note that there is an exception that EBIT can include non-operating income where applicable. For example, if Graham's company spent $250,000 last year on operating expenses, he would subtract that from his gross income of $1,650,000, which would make his company's operating income $1,400,000. Number 6, interest expense. Many companies have debts. The interest expense line lists the cost of those debts. For example, last year, Graham's company paid $50,000 in interest on a business loan. That goes on this line. Number 7, pre-tax income. The third measure of profitability on the multi-step income statement, after gross and operating income, is pre-tax income, or operating income minus interest expense. In Graham's company, the pre-tax income is $1,350,000 for last year, $1.4 million in operating income minus $50,000 interest expense. Number 8, taxes. Like individuals, companies have to pay taxes, and like individuals, the amount a company pays in taxes depends on a variety of factors. Last year, Graham's company had to pay $325,000 in taxes, so he would write that amount here. Number 9, extraordinary expenses. Many of the costs of running a company are recurring costs. For example, Graham knows that quarter after quarter and year after year, he'll have to pay his employees' salaries, buy materials to manufacture his product, and pay taxes. But sometimes a company has a one-time expense. For example, last year, Graham's company moved their warehouse from one location to another. That cost them $25,000, but that's not an expense they'll encounter every year. Any one-time expenses are listed under extraordinary expenses on the income statement. Number 10, net income. Finally, Graham will want to calculate the net income of his company. Net income, also called net profit, is the pre-tax income minus taxes and extraordinary expenses. Because it's the last revenue line on an income statement, it is often called the bottom line of a company. Remember that Graham's company's pre-tax income was $1,350,000 last year. His taxes were $325,000, and his extraordinary expenses came to $25,000, so his company's net profit was $1 million. That's all pretty straightforward, but there is one other thing that companies with shareholders often add at the bottom of the statement. That is earnings per share, which is calculated by dividing net income by the number of shares outstanding. For example, let's imagine that Graham's company has 500,000 shares of stock. When you divide the company's net profit of $1 million by 500,000 shares, the earnings per share comes out to $2 per share. An income statement is a statement that lists a company's income and expenses. There are 2 major types of income statements: the multi-step income statement, which includes 4 measures of profitability at 4 different places on the statement, and the single-step income statement, which lists only net income at the bottom of the statement. The line items on a multi-step income statement include net sales, or all the sales dollars brought in, cost of sales, gross income, also called gross margin or gross profit, which is the net sales minus the cost of sales, operational expenses, operating income, which is calculated by subtracting operational expenses from the gross margins, interest expense, pre-tax income, or operating income minus interest expense, taxes, one-time expenses called extraordinary expenses, net income or net profit, which is the pre-tax income minus taxes and extraordinary expenses. Net profit is often referred to as the company's bottom line. Finally, companies with shareholders also include earnings per share, which is calculated by dividing net income by the number of shares outstanding.